gentlemen, welcome to a very special Indianomics special because the Indian economy has grown by an unexpected scorching 7.6% in the second quarter. In our entire range of expectations, when we did the poll, there was no one who gave us a 7.6% number. As you can see, the CNBC-TV18 poll was 7.03%. But the Reserve Bank, in its forecast 2 months ago, had only given of 6.5%. So this is clearly blistering. Now, what were the internals? It was only agriculture that was a little under the weather at 1.2%. Our poll was about 2.5% for agriculture. But the surprising part was that manufacturing and industry contributed maximum. Look at the double-digit growth. Mining 10%, manufacturing 13.9%. I can't remember when I last saw a number like that, maybe 2004 to 2008. Electricity and other utilities 10% and construction 13.3%. Surprisingly, India's services sector economy actually didn't show up much in terms of services. Trade hotels just 4.3%. That's a very big sector in terms of employment. Finance 6% and public administration 7.6%. Another perhaps not so cheerful number is when you looked at GDP from the demand side, then private final consumption expenditure grew by only 3.1%. It was capital formation, which was at 12.4%, and government consumption at over 11%, which brought home such a big GDP number. Joining me to analyze the GDP numbers and to tell us whether the full year GDP numbers have to be revised sharply are three prominent economists: Shubhda Rao, the founder of Quantico Research; Nikhil Gupta, the chief economist from Motilal Oswal Financial Services; and Anubhuti Soy, the chief economist from Standard Chartered. She heads research for South Asia at StanChart. Ladies and Nikhil, thank you very much indeed for joining me. Well, Shubhda, since you are the senior most, this question to you. Does it feel like 2004 to 2008? Do we have to radically revise our expectations, at least in the near term, from the economy?
I think I'll take the last one first, Lata. Thanks for calling me here. I think we are in for a fair amount of revision for GDP because it has pleasantly shocked us by almost 110 basis points compared to our forecast. So clearly we are looking at a likelihood of a 6.5% plus for the full year GDP. And going to your earlier question, I think, does it look like a 2004, 2005 kind of a scenario? I think I would like to look at it from two halves a year. The first half gone by, which has shown a solid growth of 7.7%. It's the second half, which I would look at slightly bit more cautiously. Agriculture, led by a fair number of headwinds. The government capex, which was a strong, heavy lifting driver of growth, would start waning, in our opinion. Aggregate support would be great, but incrementally the support would start declining. The discretionary demand from the urban side would start looking on the lower side. Net exports would continue to drag. So all in all, I think H2 would be a slightly sober number. And that's why we are not really significantly revising it close to 7% for the full year as a whole.
Fair point. I take your point about your worries over consumption because the private final consumption expenditure has come in only at 3.1%. And yes, the fiscal numbers came out. Government capex in October 23 is 17% lower than what it was in October 22. Perhaps it's a one-off, but clearly the government may have to reduce support. Nikhil, to you on that point. I think like most others, the forecast, a large number of the forecasts came between 6.5 and 7%. Do you think, Nikhil, we need to revise up our full year numbers?
Thank you, Lata. Yes, Lata, the number was impressive. Not only the headline numbers, but the details are also as impressive. The first point is 7.6% headline number is much better than the highest forecast that was there on the street. We all know that. But the driver of this growth were also something that we need to be, that was really special. It was not consumption, it was investments. And within investments, we know for the last 2 quarters, corporate investments have declined. And we were expecting another decline in Q2, but corporate investments have actually increased in Q2. Despite higher corporate investments, now I have always been worried about if corporate investments pick up, we could see higher CAD because financial savings has fallen, but that did not happen. net imports of goods and services was only 2.4% of GDP in Q2 vis-a-vis 2.3% in Q1, precisely because consumption growth was weak. Because of weak consumption growth, it is very likely that household financial savings picked up a little in first half vis-a-vis FY23. So the internals, be it corporate investments, financial savings, it all was probably a picture perfect, as I would want to call it. Definitely not expected. As far as revisions are concerned, definitely we were at 6.2% for the full year. Because of Q2, we will be revising it up once again to 6.5 or 6.6%, but we still do not see it to be, it will be in line with what the RBI was expecting, which was very optimistic vis-a-vis the market forecasts. I think RBI will not be revising it significantly, but the market, the private forecasters, I will be revising it upwards towards the RBI forecast for this year.
Okay, towards 6.5%. Let's see. We will know whether the Reserve Bank will choose to, increase it. We will know it on December 8. Now, Anubhuti Sahai, welcome. You're the person who came closest to the number, actually. You gave us a 7.2% number. That's the highest of all the readings that I got when I did my poll. But it's better than the best, the most optimistic estimate. What surprised for you? I mean, how does one explain a 13.9% manufacturing? It just doesn't seem like we got any wind of it, even if we look at the IIP numbers. The IIP numbers, July, August, September is 7.4% average. This really is a bolt from the blue. How do you explain it?
So, Lata, I would just, flag three reasons why probably we got this upside surprise. First is the corporate earnings. Most of the analysts like me, we look at a smaller sample. RBI, just before the GDP number, came out with its study and data on the performance of non-financial private sector. And if you look at the EBITDA growth, which goes into the manufacturing sector calculation on GDP, that EBITDA growth was at 25%. This was in low single digits in Q1. We were building in a strong EBITDA growth, but definitely not at 25%. So that has clearly played a very important role. And if I look at the underlying factor, which probably pushed up the EBITDA growth at such strong levels, it's probably driven by very well contained commodity prices. The second part is, industry. If we look at the industry as a whole, it was a dry season for sure, but again, construction was much better, 13.3%.
Yes.
We were expecting a 9% growth. So, that was another factor which clearly surprised us on the higher side. Now, on your question, which you have asked Nikhil as well as Shubhada, can these factors continue in the quarter 3 and quarter 4? I think the support from low commodity prices, I think that is something which we probably will have to start building in. That will continue to keep the EBITDA growth at a stronger level and probably can keep the manufacturing sector look better than what all of us are building in at this particular point in time. But the support, which has come because of a dry season, should start fading from Q3 onwards. Okay. So overall, if I look at it purely from the number perspective, our GDP growth number for full year is at 6.5%. Can it be marginally higher? Yes. But some of the support factors, as Shubhada pointed out, and as the dry season impact fades away, our senses, H2 can be much more moderate than H1, but probably not as slow as we are building in at this particular point.
So you will go to 6.5 at least, you think?
We are already at 6.5. Okay. Maybe we see, like a 10, 20 basis points upside risk to this number. Okay. Given that the support from commodity prices, and even if we look at our composite indicator, the momentum still remains strong in the month of October. Okay.
Nikhil, would you bet heavily now on the capex stories in the economy? Capex seems to be very strong. The government's April-October capex is 33% higher than what it was a year ago. But, is there more to go? I'm only worried because consumption has not picked up so much. So you can't keep on creating capacity when consumption is lagging a bit. And secondly, this trade hotel services, it's the biggest employment generation vertical. And that's just 4.3%. So the short question, should we continue to back capex stories? Do they still have a good run?
That I'm not very optimistic. Yes, Q2 was much better, but whether these numbers will sustain, I don't think so. I don't believe that overall investment rate in India is going to pick up to 32 or 33%, let alone at the peak of 37, 38%. I still believe for the full year and in FY25 as well, it will remain somewhere around 30, 31%. Because we know that the center's capex has been very strong. The state's capex has been very strong in the first half, but second half could be a different story because of the base effect and because of the fact that we have elections, so the revenue spending also has to grow decently. I do not see any reason. I do not have any confidence that the government will be able to maintain 25-30% kind of growth in FY25 if they are serious about their fiscal deficit target, which must reduce by 60 to 70 bips next year. At best, they can do 15% kind of growth, which would be very moderate vis-a-vis the last 2 to 3 years. And it would be broadly slightly better than the nominal GDP growth for the next year. So I'm still not counting in the revival in corporate capex. I am very sure that government capex will weaken vis-a-vis the last 2-3 years in FY25. So no, I'm still not gung-ho about the capex recovery that we have heard in the last 2 years. And Q2 data was very strong, but still no.
Okay. Very quickly, Shubhda, do you think the Reserve Bank will therefore continue to remain tight in its policy simply because growth is so good that they may want to lean on the other side? Is that likely?
Yeah, I think RBI is going to continue with its focus on liquidity management. Could it tweak rates or corridor is a matter of opinion. Whether we see, what kind of a tweaking in language does RBI bring in the forthcoming policy on 8th. But we believe that the liquidity focus of keeping it tight and the stance of withdrawal of accommodation would continue for some time, and any rate cut hopes that were perhaps getting built in, we were of a view that it would start in Q2 of the next fiscal year. We would need to assess what inflation story, what growth story plays out over the next 2 quarters.
Well, I have to take a break, but I want one rapid fire with all three of you. So please give me monosyllabic answers. Anubhuti, full year number likely to be GDP growth?
6.5 is the current forecast, marginal upside risk.
Nikhil?
We will be revising it up to 6.5 to 6.6%.
Shubhda?
6.5 to 6.6.
Okay, so everybody is going a step ahead of the RBI number, which was already considered very strong. Very quickly, Anubhuti, rate cut expectation pushed to?
No, it's still at June 24. We expect rate cuts to start from June 24, 50 bips only
Nikhil?
in the full cutting cycle.
No, we have not penciled in any rate cut for the next 3 to 4 quarters. We do not change that.
So, Shubhda?
End of Q2, early Q3.
Okay, all right. Have to take a quick break, coming back with more questions on how government policy may change and whether consumption is something which we have to worry about. Also, more on what we should expect from the Reserve Bank after this break. Welcome back to this very special Indianomics on the extraordinarily strong number, second quarter GDP number that we just got this week. The Q2 GDP at 7.6% is perhaps among the best numbers we have heard in a decade. Joining me to discuss this were Shubhda Rao of Quantico, Nikhil Gupta of Motilal Oswal, and Anubhuti Sahai of Standard Chartered. Ladies and Nikhil, thank you very much for your patience. Nikhil, the worries about consumption. Do you think that, this will continue, or do you think the fact that there could be more revenue expenditure and that in course of time, the government capex will create its own jobs, will ameliorate this problem? Would you worry about consumption at all?
Lata, I actually fall in the camp wherein I would like if consumption growth slows down. And the growth, whatever growth we get, is primarily driven by the corporate sector. That, I believe, will be the best growth if we get it, even if it means that our headline GDP growth is slightly lower than what we want it to be. We know the primary reason is the consumption growth that we have seen in the past few years has not been driven by a corresponding improvement in household income growth, and that is why savings have fallen. Now, till the time this continues, it is all well and fine, but it has an expiry with it. This kind of growth model is unsustainable. And that is why I'm happy if consumption growth weakens, if corporate investments pick up, that is well and good. That is the kind of growth we need. And that's why I'm particularly okay with weak consumption growth until and unless it is driven by higher and improved income growth.
Okay, well, that was the message from Nikhil's recently published book, The 8% Solution. He strongly argues that we should give accent to capital expenditure and sacrifice a bit of consumption for now so that we have a sustained 7% growth. Well, Anubhuti, what about the Reserve Bank's policy? We discussed it briefly in the, before the break, but do you think, we already saw one micro-prudential speed breaker, if you please, increasing risk weights on unsecured lending. Do you think more of that is possible in the policy?
So as far as policy is concerned, I think with this such a strong growth number, it clearly gives the MPC to maintain its anti-inflationary stance. Can we see more measures to keep the rates on higher side and contain credit growth? Yeah, absolutely. They have been doing it from keeping the liquidity on the tighter side, macroprudential norms by increasing the risk weights. I think the concern from the RBI is not purely on the credit growth rate number. It's more about the quality. If the due diligence done is not at the desired level from the regulator's perspective, then yes, we can see more measures coming in order to ensure that there is no bubble eventually over next few quarters. But as of now, our sense is that probably, given that they have just announced it a few weeks back, they would like to see how this finally plays out. I mean, there are two impacts. One is there is a direct increase in risk weight.
It will be a similar policy as the one that went by, where the Reserve Bank sounds cautious but doesn't take any action, correct?
Absolutely.
Okay. Shubhda, do you think that we have to revise kind of the medium-term growth trajectory of the Indian economy? Even the most bullish economists were forecasting a max of 6.5 up until 2030. Do you think we can at least start to question whether that number is, a little bearish, whether we can see a bigger medium-term story?
I think before that, Lata, we need to also keep in mind that we are riding an election cycle, a critical one in the early part of next year, that is 2024. And we need to therefore also see, because typically we have seen private capex usually starts walking on the slow path closer to the election cycle. So capex, is going to take a while to recover fully, in my opinion. The next 3 quarters, we will see the switch of government expenditure from capex to revenue expenditure, also typical of a behavior pre-election. Looking at your medium-term growth, I think what becomes very critical and important is India has done stupendously well in dealing with all the global volatile components that were over the last 2-3 years, with broader stability, be it in the financial markets or real economy. I think the policy reform focus has remained well in place. All put together, it does sow the seeds for medium-term growth to look definitely better. 6.5 is what every economist on the optimistic side would have definitely penciled in. I think we would need to see more traction on ground on various reforms picking up momentum in execution, and then we could look at stage 2 of whether it should be closer to 7% or beyond. As of now, I think 6.5 looks more or less kind of baked in a lot of assumptions, even for the optimists.
Oh, okay. Nikhil, a kind of similar question to you. There is one optimist in me which says that, quarter after quarter, the growth is much better than any of us expected. Remember, Jan, Feb, March, the poll, I remember, was 5.1%, and we saw a number of 6.1%. First quarter was, of course, 7.8, more or less in line. That was what the polls and I think the RBI number also was. Second quarter, again, we are getting this huge surprise compared to what, when quarter after quarter, the economy surprises on the upside, should we relook at the medium-term forecast? That's one way of looking at it. The other, the bearish way, is that these are periods when there is high growth and high fiscal deficit. Let's remember, it is 5.9 plus 3% states, 9% fiscal deficit for a 7% or a 6.5% economy. So these steroids will go away. Which is the right way to look at it? Do you think these are steroids numbers and therefore it will wane, or do you think we have a different grammar of growth?
So, Lata, I will tend to agree with the second point that you mentioned.
Okay.
And we also need to understand India is not the only economy which has actually been surprising on the upside. We have seen extremely strong number, much better than expected from the US economy as well. And the reasons, ironically, are almost similar: the government spending and the personal consumption. And before we talk about slightly long term, before we think of revising upwards our long-term focus, we need to understand that private consumption growth of 3% in 2Q FY24, when we know that personal loan growth, especially the consumption-related loan growth, was very strong in the quarter. So the numbers were very good, the details were very good, but the fact that agriculture growth was only 1%, and we are moving into elections in just 6 months, which means there is a temptation of possibility of the government support to the farm sector, which may be inflationary or which may keep the RBI very cautious in terms of their monetary policy. The fact that private consumption growth is not in line with the consumption loans or the retail loans that we are witnessing, something is missing. I do not have all the answers, but unless I have all these answers, I would not be changing my long-term thesis at this point.
Fair point. I mean, that's very responsibly spoken. But I'm going to persist with my optimistic doubts. And that comes in the form of the tax collection. Exactly the number which Nikhil spoke about. You know, it looks like we will have money for revenue expenditure and capital expenditure. The April-October gross tax revenue is growing by 14%, whereas nominal GDP for that period has grown by only 9%. Somewhere tax buoyancy is better, isn't it, Anubhuti? So would you revise your medium-term outlook?
No, not really, Lata. I would say like a 6.5% is a very good number. I think what is disconnecting the growth which we are seeing in, say, personal loans vis-a-vis what we are seeing in the private consumption expenditure numbers from the GDP release is the inflation story. We are all looking at nominal numbers, but if you look at the real wage growth, if you look at the nominal wage growth, it's doing very well in urban areas, it's doing very well in rural areas. But if you start adjusting it for higher inflation, and in case of rural India, food inflation becomes extremely important. If food inflation shocks, which if they become persistent, then I think the buoyancy in consumption, which we all are expecting to trickle in because of a good capex cycle, that will take much longer. So I think it becomes extremely important to see if India as an economy is able to bring down inflation in a sustainable manner, because that becomes extremely crucial for household consumption expenditure to go up. I mean, this has been seen if you look at the last 1 decade's data. Whenever real wages in both rural and urban area move up together, the growth in consumption expenditure is extremely strong. As of now, real wages in rural area is weak. And unless inflation story is handled, especially from the food side, I think revising up the medium-term growth story just as of now would be a little premature.
Okay, point taken. Anubhuti, Shubhda and Nikhil, thank you very much for bringing some much needed sobriety to the discussion. I am getting a bit excited. As a reporter, it feels very much like I felt when I was discussing IIP numbers or GDP numbers in 2004, 2005. So there is a desire that we get a repeat of that kind of torrid growth. But as our economists warn us, we should look at some of the red signals as well, red flags as well. The fiscal deficit, combined fiscal deficit, is still very high, and it will have to be brought down. So this kind of fiscal deficit of 9% for a normal economy means that the economy is growing on steroids, and the steroids will have to be weaned away at some point in time. Secondly, there is a fear that the job-creating sectors like trade, hotels, transport, communication have not grown as fast. As well, consumption only at 3.1%. So we should not run away that the medium-term story is very good, but we can definitely say that the full-year GDP growth of 6.5%, which the RBI has forecast, will not only be achieved, but a surprise on the upside is very, very likely. wrap up on this edition of Indianomics. Thank you very much for watching.